Is the Bank of Canada's back up against the wall? Does it really need to cut its rates? Will it hold in June or July, or will we see a cut happening anytime soon? That is the million-dollar question as we sort of unpack those most recent CPI numbers, look at other data points that the Bank of Canada really wants to pay close attention to, and look at some interesting insights that I think are pretty important to consider, some things that actually flew under the radar at the most recent jobs data release there, those 90,000 jobs. So we'll unpack that and more on this week's episode. Once again, it's Friday, Finance Fridays. Thanks for stopping by. I'm your host, Anthony with In Touch Mortgage Solutions. And if you haven't subscribed, hit the notification bell, go ahead and subscribe. And don't forget to leave your thoughts, questions, and comments in the comments section below. But let's get right into our thoughts and opinions on the most recent CPI data. So first and foremost, the glaring media headlines, obviously inflation slowed 2.7%. Really good news for many Canadians paying close attention to this data point. But ultimately, even behind the scenes, core, medium, and trim inflation, the more important numbers to the Bank of Canada, are actually pulling back month over month. We've seen a steady decrease from January all the way into April, which basically pulls those numbers back below 3%. We have headline inflation now under 3% for 2-3 consecutive months. Really good news. Ultimately, the Bank of Canada does want to see inflation between that bandwidth of 1 to 3, but closer to 2. And as we approach this particular modeling that the Bank of Canada has put forward, remember, they are data dependent. They want to see this consistent, stable decline in inflationary pressures, and we're starting to get that over the last little while. Now, the question is there enough data here for the Bank of Canada to formulate a decision, or will they want to wait another month or another few months for that matter? And that is ultimately where the divide sort of comes in, where many will argue that yes, inflation is still very high, even though we're seeing food prices, pull back a little. They're still much higher than they were pandemic. I think they're up around 21%. We definitely have things in these CPI buckets like shelter, obviously interest costs, still keeping this number relatively high as more and more Canadians continue to renew their mortgages into these higher interest rates. This environment obviously puts a lot of pressure on the economy and household spending. Less money left over at the end of the month, where more money is going towards interest and spending on covering all the necessities. What's left over at the end of the month to pay or to actually enjoy things in the summer and obviously travel, all these other things. That's what we're talking about when we talk about the economy, right? So ultimately, even in the most recent FSR report, so the Financial Stability Report that the Bank of Canada does, they did complete one in April, and it did express some of these vulnerabilities, one of them being renters being more vulnerable than Canadians who own homes and have mortgages. They found that Canadians with homes and mortgages are much more resilient than, unfortunately, those who are paycheck to paycheck. And those are the people that are the hardest hit. The higher we keep these interest rates, the harder it hits to a lot of these Canadians, as they still are feeling the pressures from week to week, day to day, or month to month. So ultimately, this is the divide. Whether or not the Bank of Canada will cut in June or July, we do know that the writing on the wall is that the Bank of Canada will have to cut. I do believe that the Bank of Canada will be cutting at some point between June and July as the data continues to change. We see the probability by the major banks. Obviously, they could have their own objective reasons why they want these rates to cut. But ultimately, if we use that as a gauge, the banks are forecasting that, they have economists too that are on their payroll and they're paid big money to do the analytics, just like the Bank of Canada has its governing council and all its bodies. They're looking at the data, and I think they're putting around a 55% chance of a June and maybe a lot higher for July. Ultimately, at the end of the day, within these next two rate announcements, we will potentially see a cut. At least that's what I think. And why I think that, there's multiple reasons why I think that. So if we take a quick second and we look at some of the incidences that happen with the Bank of Canada, some of the arguments that are being put forward by Canadians that are arguing for a higher policy rate for longer, was the fact that the Bank of Canada was very slow to move on the inflationary front. A little while ago, we remember the Bank of Canada governor coming out saying, hey, we're going to keep interest rates lower for longer. That was a promise. And I do believe that at that time, as they saw inflation start to tick back up, they didn't move the needle effectively at the right time. and they made a mistake. They also believed that inflation was transitory, which we now know was not. So it took them 11 months to move the needle, and then we saw what happened. We saw the fastest rate hiking cycle in Canadian history, going from 0 pretty much to 5% in the span of around 18 months. And ultimately that put a lot of pressure, and this is where we are right now. So when we look at the Bank of Canada right now, we have to understand that are they going to be proactive in the sense of looking at their modeling, their forecasting, and saying, hey, things are getting a little hairy, a little dicey for us. We really need to start looking at it. Because yes, they do not want to reignite inflation, but they also need to salvage the economy. We need to make sure that Canadians are working and able to pay for their mortgages.
If you had a 2% increase in interest rates.
The biggest risk to Canadians coming insolvent is not having a job.
Right.
The biggest risk to Canadians not being able to repay their mortgage is not having a job.
And yes, the last time that the Bank of Canada, or one of the last times that the Bank of Canada diverged back in the 90s, and yes, unemployment went to 9%. We get it. But ultimately, if Bank of Canada is seeing that unemployment could get to anywhere close to that, they do want to make sure that they move the needle, maybe cut rates a little bit just to sort of slow that probability down. And because all these data points, all these job numbers, these inflation numbers, everything is a lagging indicator, we have to respect the lag, but you also have to look at the future and saying, what indicators, what modeling are we seeing ahead of us? And one thing that I always looked at was the immigration levels here in Canada. So yes, we need immigration. We need new people coming into the country. Yes, the government, the Liberals are changing their parameters when it comes to students, when it comes to foreign workers, temporary workers, but we're still bringing in 500,000 permanent residents. And those individuals are going to help replace the aging population. They're going to continue to generate tax revenue here in Canada, but ultimately they're going to be consuming in the economy. So the $1 million question that I always put forward, or when we're talking amongst colleagues, is what would the GDP numbers in Canada look like if we didn't have this big bump in immigration? Would the Bank of Canada had to cut rates a long time ago, or were they basically looking at a situation now where they used immigration as a tool, as quantitative easing, let's say, to sort of prop up these GDP numbers? I mean, that's a good question. Let me know what you think in the comment section below. But ultimately, all these numbers are skewed. So yes, we have immigration coming forward. And what are you getting at? Well, we definitely need these people to come, but we also need to have the jobs and infrastructure to house them. And that's where the disconnect sort of happens for me. And yes, we had a blowout month of jobs in April, around 90,000 jobs. But when you start to peel back the onion on these particular jobs and what the compartmentalization is here, well, around 50,000 jobs were part-time. What does that tell us? That tells us that, hey, what happens in this particular season, right? Because everything's seasonal. You have to look at what's happening on the bigger scale. You have, high school and university students that are trying to lock down some part-time jobs in the summer. You have the return of the seasonal workers, the pavers, the landscapers, those who were on potentially, unemployment and then returned back. They're getting their jobs. All these things have to be factored in. So you start to peel back the onion. It's important to ask the question. A lot of these jobs were professionals. A lot of these jobs were maybe in healthcare. A lot of them are in government positions as well. We've seen a huge increase in public sector jobs. And the other thing that I think flew under the radar that's really important to pay close attention to was the wage growth number, right? So remember the Bank of Canada, we've talked about on the channel, and you've heard the governor of the Bank of Canada saying, well, we need to see wages pull back. We need to see unemployment tick up. Well, wages are starting to pull back. Unemployment yet remained at 6.1%. You have less incentive for businesses to expand, which means they're not going to be hiring. You have 500,000 new people per year, just permanent residents arriving. That's not mentioning anything else and all these other numbers that could be camouflaged. Where are these people going to work? And what will these numbers look like in the future? What will unemployment look like in the future in the next couple of months ahead? Remember, Bank of Canada governors come out explicitly saying, the Canadian can afford to pay their rent and their mortgage as long as they're working.
I actually think that the economy has probably already entered into a recession. And I say that because you can disguise or camouflage the economy when you have over 3% population growth that's being influenced by the most aggressive immigration policy in modern history. But when you have 3 quarters in a row of negative real gross domestic income or real gross domestic production on a per capita basis, I say that fits the bill for a recession. And actually, if you're taking a look at the labor market, the unemployment rate might be a lagging indicator, but it is also a confirming indicator. And when the unemployment rate is up 100 basis points in a 12-month span, which is currently the case, up to 6.1% from 5.1 a year ago, that is an 80% recession signal. So we're either already there or it's just around the corner.
So will the Bank of Canada be proactive to say, hey, we're starting to see some disconnects, some cracks that are starting to form. Do we move 0.25%, which, for some Canadians may not be enough, but it could be a signal that there's better times ahead. Now, ultimately, we're not saying that the Bank of Canada is going to go on a warpath to bring policy rate back down to anywhere close to where we saw at 0%, but back from restrictive territory into a normal normal range. What that is yet to be determined, but ultimately as the economy starts to move, they're going to be slow and steady, maybe a cut, a pause, maybe another cut. 0.25%, it's not going to be as aggressive. Remember, they made a mistake. They waited too long to raise those interest rates. They don't want to make the same mistake on the way down either, because if they don't catch it and they start to see these numbers, remember, all these indicators, they're lagging. They're always backwards looking. And by the time the data rolls out, it could be a snowball effect and the damage is already done, putting the economy into recession. As we know, many Canadians, the GDP per capita, those individual Canadians, we are not faring as well as they are to the US. They are not feeling as promised, as well off as they should feel. Considering when we look at 2015 till now, it's been pretty much a flat line in GDP growth per capita, right? The average Canadian. So a lot of things really to look at right now. And yes, one big conversation point, actually two things. One thing I wanted to mention was in those CPI numbers, interesting enough, auto insurance had picked up a little bit. And I wonder if that's anything to do with all this crime, all these auto thefts that are happening. Let us know what you think in the comment sections. But ultimately, when we look at the US to Canadian dollar, this is the big conversation. This is the major bucket of many Canadians are saying you can't move too far away from the US because we're going to devalue our dollar and it's going to be worthless and we're going to import inflation. And yes, I agree with that statement 100%. But there's this fine line between our economy and the Canadian economy, sort of the world economy, the US economy and the Canadian economy. And when you think about the divergence, maybe by diverting a little bit, not far from the US, will actually make our dollar a little bit more attractive to foreign businesses that want to come to Canada as opposed to go to the US. Now, that could help with productivity, right? And hopefully, eventually, if we get more of these businesses, more productivity, more business growth, that could actually help our dollar come back up, according to some economists.
On an island, we have to talk about it in context with the US, where the mantra is higher for longer.
Right. So what I think the big thing for me is, look, there is no relationship, there are no facts that support the straw man argument, the simple straw man argument up here, that the Bank of Canada cannot move before the Federal Reserve. There is no data that supports the fact that interest rate differentials affect currency crosses over the long term.
But it does perhaps at a moment in time, whenever traders decide that's the factor driving the currency.
Could be for a week or so, but if you go back and use monthly data, I'm going to use a statistic, there is no R square. There is no relationship. And I could easily paint you a narrative where, because Canada is so much more interest rate sensitive, right? If the Bank of Canada cuts rates more aggressively than the United States, the dollar could go up because the economy would recover faster than the United States, because the United States on the private sector side is not that interest rate sensitive.
So the loonie doesn't plunge to 50 cents, say. Which
no, but you're right.
Yeah.
Could you get a knee-jerk reaction? Well, you watch the markets on a daily basis, sure,
Yeah.
but over the long term, well, let me put it to you this way. Interest rates in Europe are lower than the United States, but yet the euro trades at a premium to the US dollar. The yen, the Japanese yen, has had the biggest era of deflation or depreciation, and inflation hasn't gone up.
Yeah.
The other thing we have to really look at here is as well is that the Bank of Canada Governor Tiff Macklem has come out not only in committee hearings, but ultimately in the last press conference at the last policy rate decision saying, look, Canada has its own monetary policy, its own economy, and it's going to do what it needs to do to make sure that it helps Canadians here at home. So if we take that, we look at the bigger picture, what do you think the Bank of Canada is going to do? What did I miss in this analysis, in the synopsis? Let us know what you think in the comment section as well. But will the Bank of Canada cut June or July? Is the Bank of Canada going to be reactionary, or are they going to be proactive in their decisions, or should they be proactive or reactionary? Most central banks, unfortunately, in history, they've always been reactionary, but I think they've learned a valuable lesson here. They don't want to repeat what happened. Obviously, they don't want to repeat what happened in the 70s and early 80s, but they also don't want to send the economy into a downward spiral, which would require a lot more pressure on the rates to come down faster and harder, which could obviously be problematic. So ultimately, long-winded here, but thank you again for tuning in and watching. Let us know your thoughts and opinions in the comment sections below, and we'll see you next week. Don't forget to subscribe. Thanks for stopping by.